Hello everyone, let's start the leverage buyout model. The example we also did in the class, a private equity firm plans to acquire a private family-owned widget manufacturer. First, we will list down each and every information that is provided to us in this question, and then we will solve the question. Okay, with annual sales of 500 million. So I have this template ready. I'll just put it in the information. 500 million sales, EBITDA margin 20%. So LTM EBITDA will be 520% of 500 million. That is 100%. Then 12x LTM EBITDA means 12x is the target value. So EBITDA multiple of purchase multiple 12x. The purchase EV will be 1200. The transaction will be structured as a cash-free, debt-free deal with a possible cash injection in the beginning. Total advisory and financing fees equals 2% of the purchased enterprise value. So this fee is 2%. For simplicity, assume no amortization of the financing fee. Okay, then next is the PE firm plans to fund the deal with the following. Term loan, 3x EBITDA with a floating cash coupon rate of benchmark plus 300 bps mandatory principal repayments. All these are rates in year 1 till 5 and a 50% cash flow sweep. The benchmark rate is expected to increase from 1.5% to 3% over 5 years. So, term loan is 3x EBITDA. Either it is cash fixed or interest is paid on cash or PK paid in kind, that is not cash outflow, and then spread and sweep. Sweep is 50%. Cash fixed is benchmark rate plus 300 bps. So we'll keep this information for later. Okay, then senior notes 1x EBITDA. Next, with the 3% fixed cash coupon and 5% payment in kind, and no principal repayments mandatory or optional. Subordinated debt 1x EBITDA, 10% payment in kind, and no principal repayments mandatory. Okay, so we have 3% spread here. Okay, and all cash, right? Cash coupon rate. No payment in kind in this. Okay, then we have 5% management pool options. With an exercise price equal to PE per share offer price to acquire this company, the company's operational profile forecasts are described as this. Okay, now we will go to the forecasting of financial statements. Annual widget sales 4 million units. Okay, these two I will just highlight these. This we will use later. Minimum cash is 5% of previous year sales. Inventory is 20%. Receivable 10%. Payable 15%. And tax rate is 25%. First, we will analyze the sources of funds. Sources of funds will be term loan, 3x EBITDA, then senior notes, 1x EBITDA, then subordinated loans, so 1x EBITDA. Okay, and remaining will be equity. Purchase value is just 1200. Fee is 1200 into 2%, and initial cash is whatever the revenue was in the previous year multiplied by minimum cash. It's 1249 million funds will be utilized. So how much funds we have? 500 million. Now we will just take the difference of these. Okay, now we have sources of funds from where we will be funding the business and the usage of funds. Right now, we have the information about widget sales, 4 million units, expected to grow 10% in year 1, declining to 6% by year 5. Average prices will initially increase 5% per year, falling to 3%. So we'll start with 4 million, and growth rate is 10% in year 1 and declining to 6% by year 5. Now, this is a decline of 4%. Either we can reduce this by 1% every year, or we can just keep just 10 10, then 10 10 10, and then 6 6%, whatever you like. Now we'll apply the growth formula. We have projected the widget sales. Now widget price. Average prices will initially increase by 5% per year, falling to 3%. Now we know here 5% is the growth rate, falling to 3%. This is a change of 2%. So we can reduce this by 0.05% every year. Okay, it's 3%. This reduce the zeros. Now we have the sales divided by quantity. So we have average widget price. Now we will apply the formula of growth to get the average widget price every year. Now number of factories. Let's see in the question whatever the information is available. Widget factories and capex, 8 current factories, 2 million in maintenance capex per factory, and 25 million to build each new factory. So if we are producing 8 million widgets with with 8 factories, we are producing 4 million widgets. So in each factory, how much we are producing? 500,000 widgets. So let's assume this will remain same. 500,000 is the maximum capacity that a factory can produce widgets. Okay, so we will keep this as same, that each factory will produce only 500,000 at its maximum capacity. Now we will divide so we get the number of factories. So a number factory cannot be made in half, like zero point 0.8 or zero point 0.6 or zero point 0.4. So we will just enter round up formula here. Round up, round up, comma 0. So this we will get whole number. In this way we will have the complete factory. Okay, then maintenance per factory is 2 million. 2 million maintenance capex per factory and 25 million to build each new factory. Okay, and now we will calculate the capex. Capex will be 8 factories, maintenance 2 million plus any increase in number of factory multiplied by additional cost of the factory. So just fix the okay. This is done. This where we will calculate total capex percentage of sales by dividing this into sales. Okay. Gross margin. Any information about gross margin? Okay, gross margin expenses 50%, gross margin on widgets declining to 45% by year 5. Fixed expenses should rise in line with average widget pricing. Like whatever the increase in widget pricing is, the fixed expenses will grow accordingly. So 50% gross margin. So we will just minus 1% every year. Now cost of goods sold, whatever the sales are, multiplied by 1 minus gross margin. So we will get the cost of goods. And fixed expenses, whatever the sales are, minus COGS minus beta will be fixed expenses, and they will grow by the rate average widget price is increasing. Okay, last is depreciation. Depreciation is 20 million in the most recent historical year. Use your judgment to forecast this. So 20 million is this, and we'll keep it same. Assuming it's the same and calculate it as a percentage of sales. Either we keep it 4% of sales or we can keep it constant. Okay, now let's just multiply units into price. So let sales growth is this divided by new minus divide by old minus 1 EBITDA is 100 million. Okay, EBITDA is sales minus cost of goods sold and minus fixed expenses. Growth is in new divided by old minus 1. Depreciation is interest. We will add this later. Pre-tax income is okay. अब हमने इनकम टैक्स माइनस करना है तो नेगेटिव साइन के साथ टैक्स रेट either we can write it like this or pre-tax income multiplied by tax rate and just minus this pre-tax income minus taxes. So we'll get the same information. Till here our income statement is complete. Let's continue in the next video for the remaining part. Thank you.